Hello and welcome. For today's interaction, I'm joined by my colleague Chirag and Venugopal Manghat, the Chief Investment Officer, Equity at HSBC Mutual Fund. Welcome, Venu, and thank you for taking the time out for this interaction.
Thank you.
Now, after your MBA in 1993, can you please tell us how did you start your professional journey?
So while I was doing my management course, I was actually quite fascinated with what was happening in the country at that time. This was post the bull run which we saw in '92, and then the beginning of research firms, of the foreign or multinational research companies getting established in India, doing a lot of very at that time, I believe it was really cutting edge work. So all that I was really fascinated with, and I wanted to be a part of that industry. At that time, I was not clear exactly as to what is it that it entails, but that fascination led me to the research world. So I looked for a job, and then got into a research team, which was a small team with a small private broking entity, which was largely supporting or giving advice to some of the or to a large number of retail investors, and then a couple of large institutions on the public side. So that was the beginning. And then in 1995, I got an opportunity to join Tata Asset Management. I joined as a management trainee. Given that the organization was just being set up, the initial entry there as a management trainee I got in the dealing division. So I was part of a two-member dealing team. The first schemes were expected to be rolled out, and then we joined and set up the team, got the brokers empaneled both on the equity and the fixed income side, and then as the schemes got rolled out, we started deploying money on the money market side, on bonds, and then later on into equities as well. So that was the beginning. It was the fascination with research that got me into the capital market and the stock market in general. So
Mr. Venugopal, just wanted to understand, in fixed income, we have seen people rising in the ranks from being a dealer to a research analyst. How did the transformation happen for you?
Yeah, I mean, in equities, that transformation happens rarely. But in my case, given that I had almost a couple of years, on the research side, having done because it was a small team, it was cutting across sectors, and therefore that experience really helped. And in that short stint where I was a part of the dealing team at Tata Asset Management, I was also in my spare time after 3:30, after finishing the dealing work, used to help the research team, the fund managers to identify companies, run screeners, then set up meetings and all of that. So I was always interested and was a part of that process. So it was a natural progression for me, and I was interested always in research. It was taken on board when I joined, and therefore, when that opportunity came, I took it with both hands.
All right. Now, in the last 28 years, the equity markets, they've undergone a significant change. Looking back, what difference do you see in the market?
Yes, I think the markets have changed. Of course, the basics remain the same. That is, buying good quality companies, remaining invested, all of that. I mean, we try to identify companies and generate returns. Equity markets have generally given higher returns than most other asset classes. So all those basics remain the same. But I think the process of each of these have undergone a change. I mean, each of the three parts of the chain, which is the research part, the uh, uh, fund management part, that's the construction of portfolio, and then the dealing side as well. So all have evolved, I think, as the market evolved, and there's far more technological advancement and databases available. Everything is electronic now. The Bloomberg system is being used, and so there's a lot of change that have taken place over these years. Of course, the biggest of course is the paperless trading. I mean, everything is electronic and demat. So that was the big structural change that happened in the industry. But otherwise, I mean, over time, every single aspect has got refined, and we are closer to the rest of the world or the most advanced markets now. But I think the regulations have changed significantly. There's been so much of advancement in that, in terms of different categories, different types of funds, multiple funds. So there's a whole lot of change that has taken place within the industry. Several new categories have emerged, and I think the regulations have ensured that there is far more professional approach to each part of this chain, and from what it was at that point in time. I remember in 95, 96, and things were not even, I think, 10% or 20% of what it is today, in terms of the approach to especially the operational part of it. Everything has changed quite significantly. But if you ask me about the actual concept of fund management and what we used to do at that time and now, I think it remains broadly the same. Your sector research, the identification of new companies, running screeners, meeting companies. So all of that remains the same. The outcome remains the same. You look for good quality companies all the time, and try to remain invested. So those basic things have remained the same, but otherwise the operational aspects have all changed.
If we look at the portfolio of HSBC Mutual Fund, and particularly on the equity side, you manage around 7 equity schemes. So co-manage with other fund managers. So how do you divide the work among yourself?
Yeah, so the co-fund manager is actually a support role. The first name is actually the lead manager. So he or she is the person who's actually running the fund in that sense, and is responsible for the performance to a large extent. The support role is for at times when the lead manager is not there, or in case that person needs support or help. That is when the support the co-fund manager comes into play. So as far as I'm concerned, at HSBC Mutual Fund, I am CIO equity, so I'm overall supervising the equity investing part of the organization. While doing that, I'm also managing some of the funds that we run. So I have 4 funds at this point in time: the small cap fund, the value fund, the infrastructure fund, and the multi cap fund. So those 4 funds, of course, the last couple of months I've taken over 2 more funds, because there was some somebody has moved on. So in the interim, till the time we get a replacement, I've taken those 2 schemes. But if you look at the schemes that I'm managing, I'm responsible for those 4 schemes as a fund manager. So work is distributed quite well across the different fund managers. We have 5 fund managers, including myself. And so all the schemes are distributed between these 5.
All right. So investing itself is a very thoughtful exercise, and you manage such diverse funds. Can you explain how do you straddle between such diverse strategies?
The experience that I've had over the last so many years has definitely helped, because I've covered or tracked a large number of sectors and stocks in the past. So I've seen 2 or 3 cycles, and then and met most of the companies that are relevant today. So at some point or the other, and therefore that has really helped me take decisions faster. Obviously, different strategies need different mindset and approach. To that extent, you need to apply your mind and therefore spend time, quality time, give quality time to these different strategies. um, I prefer to have my universe created for the each of these strategies. So for a value fund, I have a certain screen. I have a universe that I have in mind, and so that's plugged into the Bloomberg system. For a small cap, I have a different universe. So I work with a universe of stocks. So that again helps me take quicker decisions. Yeah, and uh, depending on the objective of the scheme and depending on the flows, etc., then from the universe and with your experience, you can create portfolios and run portfolios. In any case, I don't churn the portfolio too much, so it's a very low churn portfolio. My approach has always been to stay invested for longer periods of time and let the companies and perform, or the businesses perform and compound. And to that extent, therefore, it's the effort that goes in at the beginning to identify the company and log into that business, and then keep tracking it. So that part is obviously done by the research analysts also. So it definitely helps as a team in managing a universe of stocks, and then as a fund manager you have your own universe and take stocks from that.
How will you define yourself as an investor? What kind of stock or situation excites you?
So I like companies that are growing faster. I think India is a growing market and will continue to remain a growing economy and market, therefore, for a long period of time, and which is therefore the exciting opportunity for investors. And therefore, what excites me as an investor is actually that growth. So I like companies that can grow faster. There are triggers for that to happen, which could be multiple things. It could be tailwinds for the sector. It could be a change of management. It could be new product introduction. It could be new markets that they are addressing. It could be any of such things. It could be a change of pattern from the or handover from the father to the son or daughter, as a manager, as a promoter. So any of such things can change the fortunes of the company. And if you are in the right business, run by the right people, then that's all you need to really focus on. So that's what excites me. Good quality businesses where there can be a change, where there can be a improvement. That excites me as an investor.
So that's what excites you. What kind of stock will you never buy?
Yeah, I think poor quality companies, poor companies with poor governance standards. So these are loosely defined terms, but in general, when you have seen different cycles and have had the experience of seeing some companies really perform well, then falter. They, because of various reasons, and their commentary to the investors, their alignment with small investors. So all of that, when you see, and the past track record, when you have in front of you, you would not want to really participate in them, even if the story is likely to get better. So those are companies which I would avoid. Highly leveraged balance sheets, generally we avoid. So that's something common to most of our fund managers here. And very high capital intensive sectors where it's difficult to really generate high returns is again something that we don't prefer. So outside of that, I think I have an open mind.
So the thing is, when and what kind of stocks becomes a compelling buy for you? The stocks which which enters the portfolio.
Yeah, so the point I made about a positive change that can drive businesses forward is something that I like. If they're coming at very good valuation levels, or if either you are one of the early investors there, then that becomes a very compelling opportunity. In some cases, companies tend to be in a poor cycle, and or for some reason on a poor performance streak, and then something changes, and at that point, at an inflection point, if you catch them, that's when it becomes a very compelling buy. So those are times which many times they are, I mean, or it is maybe less number of times that you get such opportunities, but that's those are the ones really which help you create significant alpha and wealth for investors. I really like to stay invested in good quality companies to let them perform and grow to bigger sizes over time, yeah, and really enjoy seeing companies grow to much bigger levels and scale over a period of time. So that's something that I really like. So if I get it really early in the cycle, then that becomes a really compelling buy.
Is there any anecdote that you'd like to share here?
Unfortunately, I can't give stock examples, but if you look at some of the portfolios that I run, the churn ratios are less than zero point 0.2, 0.15, 0.25, that kind of churn. So there are several stocks that have remained in the portfolio for the last 5 to 7 years or so, and many of them have therefore multiplied as well with the market growing, the economy really performing, etc. But it's great to see companies do well and grow in size, and that giving gains to investors.
The sector call which you have invested before the market has started looking at that particular sector.
Yes, I mean, so we do take sector calls. I mean, the analyst is responsible more for giving a sector call, but the fund managers, we are largely bottom-up investors, so we don't prefer to invest based on the economy and then a sector, and so we don't so much employ a top-down approach. It's more how the company is performing and what businesses are turning around or likely to do better. What is the growth that you're expecting and what is captured in the price, etc. That matters more than a sectoral view. Of course, some themes that are playing out, like, for example, investments theme or the infrastructure theme or consumption as a theme, these are powerful themes, large themes that run for longer periods of time. And so to that extent, I mean, that becomes a overarching thought. Then within that, then you start looking for more ideas, and then more bottom-up research goes into stock identification.
Since markets are at all-time high, and we have seen many of the stocks trading at multiple high valuations, so what's your take on the section of stocks that investors have fancied and are which buying at any prices, what the markets call it the BARB stocks? What's your view on it?
I mean, any market you will find such instances, and it's good to avoid some of those where stocks are quoting at normal valuations. But you'll have to also carefully understand the factors that have or that are behind those valuations. Some great quality companies can really grow at a higher pace for longer periods of time, and therefore can compound for long, and to that extent may get a higher valuation for longer periods of time. And in very strong liquidity driven markets, with strong fundamentals as well, you might see valuations going up even more. So there are in some cases reasons for such high levels of valuation, but those you can stay invested, or you may want to trim your positions. But but where those are not justified, where growth is likely to come off, where those are more of short-term gains for the business, more opportunistic kind of things. I think there you have to be careful, and one has to be very wary of such situations where valuations have run up too much, and it can't be justified with the fundamental prospects.
So is there any particular thing at the fund house, where you don't invest in higher PE stocks or the lower PE stocks? Is there any threshold or benchmark regarding the high PE stocks?
No, not really. I mean, which is why I said every stock you have to analyze and see what are the factors that go behind it, what are the reasons for those valuations, and then see if the company or the business can continue to deliver those valuations, continue to deliver that growth that the market is expecting. Cases where the runway of growth is very very long, and where the business where the promoters or the managers are really high quality, well aligned with investors' interests, have been of a high professional conduct, and integrity levels are high, brings a lot of passion and energy to the business. Those are cases where high valuations will continue to be the case. I mean, I don't think you will get cheap valuations in those stocks. Even if you get those cheap valuations, then, like you asked me earlier, those become very, very compelling buys. So in a large part of, let's say, if I have to give you an example, I won't quote stocks, but in general, within the, let's say, the consumption basket, there could be a number of cases where companies and businesses can really multiply over the next 10 years to become very large companies. I mean, some of them can come into the index at some point, because we have seen the same trajectory of growth in multiple other economies in the past, multiple markets in the past, and given our demographics and income growth that is expected, it's most likely that some of these companies will really scale up to very large sizes. So it depends on what kind of company, and how do you see its prospects going forward. So you can't paint everything with the same brush and say that high valuations, I will stay away.
All right. Now, before we close this interview, one last question. The HSBC Midcap Fund has underperformed for a while now. So, can you please share how do you plan to improve its performance?
So the Midcap Fund has outperformed in this calendar year now. Year to date, I think the performance has been fairly good. And even up to, I think, with this performance in the last 6 months or so, the 2-year performance also caught up, and it's come fairly, it's improved fairly well. So it's a high quality portfolio. It's a portfolio very which has been created with a lot of thought behind it. It's not a flavor of the season kind of portfolio. So it's a portfolio with companies at reasonably good valuations as an entry point. So valuation has played a very important role there. It's a company where it's a portfolio where businesses have been bought into with which have a long runway of growth. It's just that it has taken a little while longer for those to really start outperforming and delivering numbers. So now we are seeing the benefits of that. So I don't see any need to really materially change the portfolio or do anything to that. I think the fund is running fairly well now.
All right, then. It's time for us to wrap up this chat. Thank you for taking the time for this interaction.
Thank you very much for having me on this show, and it was a pleasure speaking to both of you.